Welcome. In this video, we will talk about stopping your SIPs. Every time the market starts going down for a longer period, this question, should I stop my SIPs, strikes most of the investors' mind, and many do react and stop their SIPs only to start after the market goes up significantly. Is it a right decision to stop the SIPs? Apart from the comfort that you are only investing when the market is going up, the investor who is going to stop his SIP is going to be a very big loser. In fact, he will lose all the opportunity or the potential that the market gives to make very big profits. While there will be a question in the mind, I am losing money in my investments. When we come to the market, in investing in mutual funds, we are coming for high returns, and for that high returns, we want to stay for a longer period, right? And this high returns doesn't come in a straight line. If it is to happen like that, it is going to come only through FDs or RDs or recurring deposits, which is a product like a juice is already taken out of a cane and only crushed part is remaining. That is what is FD and RD, whereas market is full of juice. That to create that higher returns, it has to have some small drops and bounces. Like when you hit a ball up, what happens? Ball comes and hits the floor again and bounces back, right? One difference here is when the ball comes and hits the floor is at the same level, whereas when you come to the market, the floor itself goes up. Every time market comes down, the bounce it takes is from a higher level, thereby taking the market up and up every time it takes a bounce. That is what helps us to create big returns in the market. So, need not worry about the negative returns that you are having in your investments. This is a small period. When the market starts going up, you will start seeing positive returns. While if you start acting on your emotions and thoughts and take decision to exit the market, that is where you make your notional losses a permanent loss. Today what is there is the paper loss. If you stay invested, market goes up and you are going to see profits in your investments. So, stay invested, you will for sure have a profitable exit in your investments. Is there any advantage in doing SIPs? This question of late a lot of people started asking. Same thing was there when markets went down previous time also. Suddenly people come out with a thought that what I am doing, is it right what I am doing? So, now since SIPs are going down, the market is going down, SIPs showing losses, people start asking this question. If you are doing SIP, that is one of the amazing magic formula to grow your wealth faster. If you are doing SIPs in mutual funds and that too into equity mutual funds, it gives you the biggest advantage to become wealthy at the fastest pace. While to help this magic formula work on your investments, you should stay invested on the both up and down sides of the market. And another beautiful advantage with SIPs is it buys lesser quantities when the market goes up and buys more quantity when it goes down. This is what creates that magic formula or makes that magic formula work. Let me give an example. Our channel is well known for ITC. When we put our title for ITC video, a joker in the market also or people also made us jokers. We are also becoming a meme in the market that you are a fool to buy this stock. I started talking about ITC when the stock was at 250 and did a lot of work to buy the stock. I told a lot of people also. I made a strategy to buy the stock every time the price dips 5% and increase my investment by 10% every time there is a drop. From 250 till 135 we started buying. By the time the stock came down below 200, people start talking like, you are a fool to buy this stock, the stock is not going to go anywhere, company is done, finished, all those things. Our average, because of buying at lower and lower when the price went down and had bought at higher quantities, our average cost of holding came down below 200 rupees. Today, all of you, since you are in the market, you had the opportunity to see news about ITC, newspaper, TV, social media, everywhere ITC is being talked about. I think today it will reach 300 rupees. So, our average cost of holding for ITC is less than 200. We made 50% gains, and the dividends in the last 2 years we have made 22 rupees dividend per share, and this dividend is going to be everlasting. So, that is the kind of magic which SIPs create without our knowledge. should I not stop my SIP? So, in SIPs what we do? We give an interval to trigger the investment on a regular basis. This creates a discipline in our investment. So, when we are disciplined, the outcome is going to be positive, right? We will be successful in our investment. While in the SIP, if suppose it is going in an up market, the moment we hit the market, the SIP hits the market and buys our units, next day we are going to see profit in our account. That is because every day market is going up and up and up. So, as long as the market is going up, we are going to buy, our SIP is going to hit the market and we are going to see profit. This is creating a happy moment for the investor. We feel very happy to see our investment growing regularly. While there is a discipline of investment, the challenge is in up market, SIPs keep buying at higher and higher and higher levels. So, though we are making profits, we are not going to make the profit that the market is making. That is because we are buying at higher levels. In SIP, like how it is buying at higher level, it is also going to participate in the market when it is going down. So, when it is going up also it is buying, when it is going down also it is going to buy. The advantage here is when it goes up, it buys lesser quantity. When it goes down, it buys more quantity. That is where we have an advantage. So, if we stop our SIP when the market is going down, we lose this huge advantage of accumulating the market or more quantity of the market, and that which when it goes up will create a big profit, which we will again lose it. I will give an example here. All of us know about the petrol prices, which has been increasing in the last 5-6 months, right. Very few of us did not expect the price to go above 100 rupees, while it crossed 100, it went to 110 too. If suppose you are going to a bunk and putting petrol for 1000 rupees, we used to get 9 liters of petrol for 1000 rupees at 110 rupees. If suppose your car is giving you 10 kilometers mileage, for 1000 rupees petrol we were able to reach 90 kilometers. Now, because of excise duty cut by the government, prices have come back to 100. Suddenly, what you used to get 9 liters is become 10 liters. So, you can travel another 9 or 10 kilometers more with the same 1000 rupees of petrol. That is what happens with SIPs also. It buys more of the market when the market is down, thereby helping us make big returns when the market is going up. For an asset like mutual funds, which is only going to go up in the long run, averaging at lower price is a biggest advantage. And not only that, here we also get to buy more quantity when the market is cheap. This is what SIP helps us do when we continue to be participating in the market even on the downside. So, SIP is advantage only if we are participating on the downside of the market. If we are doing your SIPs only when the market is going up, generally tend to not make the returns that market gives. The returns are going to be very, very less. While participate in the downside of the market, that will help you gain very big returns. So, instead of thinking about stopping your SIPs, it is actually good to increase your SIPs. Like say, if you are doing 10,000 rupees SIP, increase it by 1000 rupees when the market is going down. So, now market is down 15%. So, your 1000 rupees SIP or 10,000 rupees SIP is going to get you 15% more units. Upon that, if you are adding 1000 rupees more, that is if you are adding 10% more to your SIP, you are going to get 25% more of the market, the same market which is going to go up in the longer run eventually, right. Market will not come to zero. Like how when we came to this world it was happy, when we are going to leave the world it will be even more happier. Very, very few instances where when we leave the world we will see sad moments like war which is happening, which is again a very rare occurrence. Otherwise, the day when we came, world was happy. The day when we are going out is going to be even more happy. That is how the market is. It is happy always. It is growing on its happiness. So, continuing your SIP, taking advantage when the market is going down by adding little more helps us to create wealth faster. Higher than market returns. Can I make more returns than what market gives? As an investor, every one of us want to have the returns that market gives in our portfolio too. That is, if Sensex is given 15% returns, I want my portfolio also to give 15% returns or even more rather, right. We want to make more returns than the market. Every investor wants to have higher returns than on their investments. This is possible with SIPs. How it does? By doing an SIP, what happens? It keeps triggering your purchases every month or the interval what we fix. It keeps buying at the higher levels, also buys at the lower levels, thereby creating an average without our knowledge. If suppose we have to interfere, it will not help us do this. We generally tend to hold back when something is going up and react when it is going down. I want to tell something here. 90% of the investors in the market don't make what the market gives as returns. That's because of behavioral bias. We react to our emotions and sentiments and take actions which is mostly wrong, thereby end up buying the market at the highs and selling at the lows. Just the opposite of what needs to be done to become wealthy. This gets avoided in SIPs. No matter whatever is the market condition, SIP gets triggered and keeps buying. If it is higher market, it buys lesser quantity. If it is lower market, it buys more quantity. Thereby, we naturally get an average of the market, which generally is about 1 to 1.2% lower than the average market. That helps us create higher returns. Let's look at some examples. If somebody wants to invest only when the market is going up, that is, do their SIPs only when the market is going up, the average returns that they will make is 33% of what the market makes. If suppose market is made 100% returns in some period like 2 or 3 years time, this person who is going to do SIP only on the upside is going to make only 33%. This is because this huge gap is because of only participating in the up market. I will take a real life example here. This chart what we are showing here is between 2006 to 2010. In this period, market went from A to B, again came back to A, then went back to B. This happened over a 5-year period. This 5-year period returns was 104%. In the whole 5-year period, market gave 104% returns. Let us take two investors. One person is investing only when the market is going up, doing his SIP only when the market is going up, and another person continues to do the SIP throughout the 5-year period. So, for the first investor who stopped his SIP when market started going down, he had 24 months period to participate in its SIP, and after that it got stopped because market was going down. In that 24 months, if suppose investor A had done a 10,000 rupees SIP, he would have invested 2.4 lakhs. On the date when he stopped his SIP, that is after 24 months, the investment was 2.4 lakhs, the value of that investment was 3.2. Investment made about 80,000 rupees gain, which is somewhere around 32% return. Investor was very happy because he's made fantastic returns in the last 2-year period. And after that he stopped because market is going down. Now we will come to the next second investor, investor B, who has continued his investment without any disruption over the period of 5 years, that is 60 months. So, for 60 months 10,000 SIP, he would have invested 6 lakhs, and on the date of the 60th SIP, his investment value is 8.84 lakhs. 2.84 lakhs more returns or profits on his investment. This compared to the investor A who stopped his SIP is 15% average returns, percentage returns on the investment, and the amount of money that is made, there it is 80,000, here it is 2.84 lakhs. This is the advantage of participating in down market, which buys more quantities as the market goes down. So, in the whole 5-year period, market went up and came down, again it went up. So, the person who stopped his SIP at the end of 5-year period, his investment still remained at 32 only, 3.2 lakhs, whereas the person who continued his SIP, he though invested little more, 3.6 lakhs he added, his profit has become 2.84 lakhs rather than 80,000 which the investor A has. This is how we can maximize returns by using SIPs. SIP is one beautiful process which helps us to gain wealth or create wealth without our knowledge. We should just be disciplined and be participating in the market. Market will never go down. In 10 years down the line, India is going to be the 3rd wealthiest country in the world, and if we have to be at that level enjoying the growth that India had, we should also participate in the wealth creation journey. That happens through SIPs, and every 2 to 3 years we have this opportunity of markets going down, giving us an opportunity to scoop the market at the lower levels with higher quantity. Similar condition like what we talked about in 2006 to 2010 happened in 1819 also very recently. After 1819, 2021, all of us know the gain that market had. Now it is going through another correction, which probably will continue for maybe another 9 to 12 months period. Looks like 23-24 can be another very big good run. So from here, next stop for Sensex is likely to be at 75,000. So at 50-52, how much drop is possible? Maybe another 10-15%. It can go somewhere around 40 to 43, and from there 75. Look at the profit that we can make, easily 35 to 40% in the next 2 years time. This is the opportunity to grab the market at lower levels. Try to get as much as possible so that we can maximize your returns. Don't stop your SIPs. Think about increasing if possible and make the best out of your investments in Indian markets. Here we talked about the 60-month period of SIPs. In that, investor A stopped at 24 months and after that he didn't continue for the rest of the 36 months. Why this happened? Generally, it happens with everything in our life. We want a confirmation. It's a confirmation bias. If it can be with any learning skills or even exercises for that matter. Let's take an example. Like say, on a rainy day when I am going out, I slipped and fell down. That creates a fear in my mind. And next time when it is raining, I will think twice to go out. I will want to put a footwear which is holding my grip strong in the floor, and also after that I want to check it whether I will not slip and fall, or rather I will even make a decision that let me wait till the rain stops and then go out. The same happens with the markets also. When your investments, after you stop your SIPs fearing of losses, you will want to wait for a confirmation to see the market go above the place where it created the fear. Only then we will start investing. So by interfering into your SIPs, we generally end up buying only at the peaks, and more important is people start reacting when it comes down. If the market stays down for a longer period, which is actually a boon for investment, people start reacting at the bottom. Now, as more people are stopping their SIPs because of fear, if you observe the market, FII participation is negative. FIIs are moving out of the market. 2.5 lakh crores have been sold, while all that FII selling is being absorbed by domestic institutions. All the mutual funds buying is absorbing all the 2.5 lakh crores. So, though there are people who are stopping SIPs and taking out money from the market, this mature investors, that 10% who make more than market returns, they are adding to their SIPs. That is what is creating or helping mutual funds to buy the market at every dip. So these FIIs who are going out now are going to come back into our market and buy at higher price. Is whatever domestic money which is coming into our market is sticky money, which will not move out like how FIIs are moved out and coming in often. We are not going to sell the market. Retail investors are not going to sell the market. So obviously they are going to come and FIIs are going to buy at higher prices. That will push the market to a significant higher levels. This is what is going to happen in 23-24 when FIIs come to India and start buying all this 2.5-3 lakh crores what they are moving out now. That will push the market to 75,000 on Sensex. So be wise, like the smart investors who are adding their SIPs or pushing money into the market to grab the market at lower levels. If suppose market is going down by 5% from here, add more. If it goes down even further 5%, add even more. That way you are buying more at the lower levels and help you make big returns when market goes up.